There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery going to be along to get us up to speed on the action from today's session. I'll start with major averages. We've got the Dow up 105 points. That's about 0.25%. Obviously, traders still closely watching the trade headlines, and Commerce Secretary Howard Lutnick, who's been participating in those talks in London, reportedly saying that the latest round went very well. That said, we saw a little bit of a leg up, but nothing huge here. The S&P 500 up about 0.5%, and the Nasdaq up about 0.6%. Jared's got a closer look at today's action.
Thank you, Julie. If you're keeping track here, the S&P 500 now under 2% from its record high. It's basically been there for a few days, not moving that much day after day. And that's because as bull markets evolve, volatility tends to dry up. So we're not seeing a whole lot of index movement. That is a good thing. And here's the VIX. VIX falling to multi-day lows. 16.87 is the closing level today. And if we take a look at the 10-year yield, that is back below 4.5%, and the 30-year still below 5%. We got some big auctions on deck tomorrow and Thursday as well. We had a 3-year today, and I didn't really see any hiccups from that, so good news there. But we'll be watching that tomorrow as well as CPI. So here's the U.S. dollar index up just barely today. Nothing to write home about there. So let's move on to some of the sector action, and let's get to that right here. And today we have energy up 1.8%. That was in the leadership spot. Then we have communication services, consumer discretionary, healthcare, and all of those up 1% or more. Only industrials fell into the red today. And we'll take a look at the Dow Industrials in a second. But first, here is the NASDAQ 100. Tesla, 2 days in a row, up nicely. That's Netflix. Let's see if we can get Tesla there. Yesterday was up 10% off the lows, and that was not the net amount. That was from the lows. But over these last 2 days, up 10%. And then since last week, let's just put a 10-day chart on there. You can still see it's underwater from that big sell-off we got late last week. But nevertheless, Tesla coming back here today. Meta, Alphabet, each up more than 1%. Netflix, which I pulled up a minute ago, that was down about 1.7%. And I promised the Dow, so let's leave off on there. Kind of a little bit of a mixed board, more green than red. Visa up 1%, Disney up 2.5%, Merck up over 2.5%, and Nike, that little square down there, rectangle rather, that's up 3%. But the red spots, we got Salesforce, McDonald's, and Cisco, each down more than 1%. Back to you, Josh.
Thank you, Jared. For more on the latest market action, let's get to Globalt Investments Senior Portfolio Manager Keith Buchanan. Keith, it is good to see you. So obviously the markets, Keith, have roared back off those April lows, and it feels like they want to keep grinding higher here, Keith, but it sounds like you have questions about how much upside could be left. Walk us through it.
Absolutely, and thanks for having me. Right at these levels, near all-time highs, trading at 22 times next year's earnings. They haven't really come down that much, even though there's a lot of rhetoric around last earnings season, what the impacts of the current level of tariffs could be. That earnings number really didn't come down significantly in order to really discount potentially the tariffs having an impact on P&Ls going forward. So we're concerned. I mean, in January, there wasn't a lot of concern about the tariffs and the blowback from an international trade standpoint. Also, the retaliation on the part of some of our trading partners. None of that was really in the mix then, and we traded at 23 times earnings on a go-forward basis at the last highs that we're approaching right now. The scenario is totally different right now, and the valuation we feel like is hopeful for continued negotiations that end up with a positive outcome for U.S. trade. However, anything short of that, we think the current landscape is probably problematic for valuations, even implying something even more positive than the 10% across the board, and even some of the April 2nd tariffs to get pulled back near that level as well. So we're just concerned about what the market is assuming here 22 times, and the growth in earnings that potentially the earnings level could be under threat if that level of tariffs doesn't come down pretty soon.
So, Keith, are you guys getting defensive then here to reflect that view?
Right, we're more cautious. I don't know if defensive would be the complete way to describe it. We're looking at precious metals as a way to express some of our opinions and our conviction. We have a position in gold and also recently moving in other precious metals as well. So, and also we're underweight global equities, primarily that's in international as well, And also fixed income, we're worried about what this higher level of rates could do to the fixed income market, particularly on the corporate side as well. So we're cautious, not necessarily, really putting on and pressing bets on the negative side. But we like to see things continue to develop from a trade standpoint. The rate environment also, we feel like is ringing an alarm that perhaps isn't being heard in equity as well. So we have there's a lot to really play out over the next 6 months that we're really focused on.
Where's the Fed in all this, Keith? What are your expectations there?
They're between a rock and a hard place. If we have the tariffs, they've communicated, Chair Powell did at the last meeting, how tariffs, in the last couple of meetings actually, how tariffs pose a threat. And the dual mandate kind of puts them in a really tough spot as far as being able to pull back on restrictive policy because of, in their opinion, the tariffs offering more inflationary pressure. But it also comes at in their opinion, also a pullback on growth and potential growth as well. So their position thus far has been to stand pat. We don't really see that changing necessarily in any dramatic way over the course of this year, as they, just like the market participants, are looking to see. I guess we'll get a bit of a window on this tomorrow, just how tariffs will affect the pricing environment. And also, does that come at a detriment of growth over the rest of the year? It's still yet to be determined. And there are a lot of academic, theories around that in both directions. So we have to see it play out in real time. And the markets are priced for an optimistic scenario that we are really cautious of right now.
As you mentioned, CPI is coming tomorrow. We have had stocks be sort of intermittently rate sensitive as of late, Treasury rate sensitive. So is that something you're going to be watching? We also have a bond auction on Thursday that I know a lot of market participants are watching. So what's that feedback loop from bond yields to stocks, and what are you looking at?
It's somewhat broken, and it not typically happens in that fashion. We've seen stocks roar back from a valuation standpoint. It's pretty much been multiple driven, and that we associate that with positive outlook for earnings, and also for earnings growth, for margins, and general profitability. The fixed income market hasn't really come back as optimistically as the stock market has. And we feel like that's raising a bit of a red flag, as they are picking up on cues, not only from the tariff negotiations and how that all seems to be playing out, but also the federal debt. And, we at our firm have voiced for a very long time the concerns that the federal debt could bring on the U.S. economy, as well as just the broader investment landscape from a global perspective. So we're looking at the fixed income market telling us a clear message that the equity market is not at this point. And typically we've seen in the past where the fixed income market has been earlier, but more likely to be correct over time. And that draws concern as well.
What do you make, Keith, of those portfolio managers who come on the show and they're more constructive, they're more bullish, and they say, listen, keep it simple, don't overthink it. Earnings solid, employment solid. What do you make of that?
We feel like the earnings, there's a lot of overlap in the Venn diagram between earnings and employment. And employment tends to lag at least the forward-looking earnings mechanism of markets. We think a lot of that depends on how things pan out from frankly, coming into this year, we saw growth really start to slow on the margins. So we feel like it was a weakening environment coming into the spring, and the tariff negotiations really just added a lot of uncertainty behind business decisions, which we know that optimism drives growth, especially in a weaker, softer part of the economic cycle. So we think, of course, the earnings picture looks great right now from what's a consensus standpoint. We feel like those numbers are at risk if the tariff negotiations don't go as optimistically as the market expects. And we feel like that's a real risk going forward for the rest of this year. Again, there's no negotiation between U.S. and China will play a huge part in that. But the market appreciating and embracing the consistency and optimism of the U.S., which naturally comes to the U.S. Business environment, we feel like is potentially at risk to a little more uncertainty, which leads to that valuation not remaining at this level of 22 times earnings.
Keith, thanks so much. Good to see you.
Thank you.
Well, let's keep talking about trade here. While the number of Chinese imports entering the United States significantly lower compared to a year ago, Chinese goods are still arriving in the States via other Asian nations. For more, let's welcome in Yahoo Finance's Rick Newman. I mean, this has been sort of long-standing practice, right? Ways for China to try and get around existing tariffs. So what do we know about what's happening now?
Well, it's only long-standing when Donald Trump is the U.S. president imposing tariffs. But yeah, it's a pattern we saw in 2018 and 2019. This is known as transshipment in trading lingo. And basically, it could mean one of two or three different things. So first of all, when there's a big tariff differential between countries right now. So the tariff on Chinese imports is 30%. That's the new tariff added this year, and the new tariff on everybody else is just 10%. So if you're a Chinese company and you can first ship your products to another country, such as Vietnam or Cambodia, and then ship them to the United States, the country of origin then is Vietnam or Cambodia, and the tariff is 10% rather than 30%. And that's a big difference. If you're an importer or an exporter, that 20% differential is a big deal. So that is reason for companies to do that. The other thing that's been happening since Trump's first term is the Chinese companies have been diversifying out of China. So most of the companies that produce stuff in Cambodia, as one example that comes to the United States, most of those companies are actually owned by Chinese firms. So Chinese producers themselves are diversifying outside of China. And now we're seeing this playing out in the trade war, and a lot of people predicted this. So fewer imports coming from China, but a big jump in imports coming from those neighboring countries.
So what's Trump's response going to be to all this, Rick?
Well, he and his trade advisors are aware of this trick. The part of the purpose, I think, of the so-called reciprocal tariffs, those are the tariffs that Trump announced on April 2, but then he suspended them on April 9, and those could go back into effect at the new deadline of July 9th. But those tariffs were higher on some other Asian countries than on China, higher on Vietnam and Cambodia, for example, than they were on China. I think in part because they realized what happened the first time around with the Trump trade war was a lot of the goods just came into the United States via a third-party country. Now, what Trump's trying to do is make trade deals country by country. Vietnam has actually been very receptive to that. They seem to be looking for any way they can to avoid a higher tariff. But this is import-export whack-a-mole, guys. I mean, this is what happens when you create these weird distortions in global trading markets. These companies are very clever. They have a strong motive to ship goods at the lowest possible cost, and they are moving stuff around all over the place.
All right. Thank you, Rick. Appreciate it.
Bye, guys.
Coming up, it's what to watch for on Wednesday. We'll get you set with everything you need to know to kickstart your trading day. Stick around, much more market domination overtime coming up.
Economic uncertainty, climate volatility, AI-driven threats. It's a world that is getting harder and harder to insure. But Axis, a specialty insurer, is focusing on a wide spectrum of risks from property damage to cyber threats. Joining us now, the CEO and president of Axis, Vince Tizio. Vince, thanks so much for being here.
Great to be here.
Well, as I mentioned, it certainly feels like a riskier world. And so I imagine that has been good for your business. I mean, what have you seen just in broad strokes in terms of demand for specialty policies that are aimed at targeting sort of these very specific risks?
There's an increase in the need for customized solutions that's resultant in part by the uncertainty that we're facing geopolitically, geoeconomically. And this has led customers seeking more customized solutions. And as a specialist, that's what we're here to serve.
I'm curious, Vince, you've got a real global perspective there, right?
Sure.
How does the U.S. compare and contrast with the rest of the world in terms of the just overall risk landscape?
You know, the velocity and the pace of change is a global phenomenon. The responsiveness of customers in the United States in their purchasing patterns is felt much more directly given how the business is intermediated. In the London marketplace, our second largest marketplace that we transact, it's a marketplace that's transacted through Lloyd's, and there's a very particular style. But what we see is the emergence of submissions staying more in the United States, less in our London marketplace, trying to be much more responsive to the dynamic change that's going on.
Where are you seeing the most demand in terms of categories? What are being seen as the biggest risks that people need to insure against?
Yeah, broadly, we're seeing demand. In the first quarter, we've reported some 24% improvement in submissions. That was broad-based, but more specifically, our energy business, our cyber business, our professional lines businesses, they're all thriving and fairly robust in the dimension of demand.
Talk more about cyber is interesting, Vince. Talk about that product and just the trends there you're seeing, the book of business. What does it look like?
Yeah, so this is a business that Access maintains a strong market share, but the phenomenon that I would describe in the cyber customer space, first, the sizing of it's about $12 to $15 billion. It's a global product that's sought by all sizes of companies, but what we're seeing is the proliferation of loss activity under ransomware matters. We're seeing continued privacy matter losses that are arising, and we're seeing very specific approaches by underwriters in attracting the kind of customers that they wish to retain and seek.
And are you seeing more of those policies be triggered because of increased cyber attacks?
You're certainly seeing frequency on the rise from a variety of sources of claims, and it's affecting different size companies in different orders of magnitude, but generally frequency is up.
Vince, one big trend we talk a lot about in the show, and it excites investors a lot, is the mega trend of AI. I'm curious how you're trying to leverage that technology and what you see more broadly in the industry as well.
Yeah, in critical ways. So first, we're looking at the use of AI inside our organization. How do we make it more efficient, more effective, and help our underwriters ultimately in risk selection? Secondly, our intermediaries. Today, we transact business in very traditional ways, starting from how we convey paper to one another, right, electronically. Third, we're looking at it from the customer lens, and we're looking at it in the development of further customized solutions. How can we leverage all of the analytics that we have to bring more specific and tailored solutions? And then finally, ultimately, the culmination of this should translate to continued stability and resilience in our profit and loss statements.
When you look at the big risks that are facing companies right now, certainly tariffs would be on the list, at least for some of them. Is that something that companies are taking out policies to insure against?
Well, the impact of tariffs is felt through the provision of many of our products. We've spoken about the impact to Access as being one, we look at loss cost trends and the impact of tariffs on how we're pricing our products. Secondly, a sustained impact of trade relations would ultimately impact growth in certain of the lines of business that we compete in. And so we have an observant eye. It's a fairly uncertain outcome, as you know, as of now, but we will continue to meet the needs of our customers.
As you look into the second half, Vince, I'm just curious, on your radar, are there certain risks that would be front and center right now that you would highlight?
You bet. So we're going into hurricane season, of course, right? And if you read the findings of what is predicted from NOAA as one source that we look at, increased storm activity as compared to the prior year. So certainly we're a large property market in the United States and globally. So we want to be certain that we're there for our customers should the hurricane season bring financial and economic damage to them and their people. Additionally, cyber, we've spoken about the continued proliferation of frequency. So we're being observant there. And ultimately, public companies, private companies have directors and officers. They have to bring governance. They have to bring fiduciary duty responsibility. So we're being observant in how we protect those company boards everywhere in the world.
Just one follow-up on the hurricane piece of that. There are some concerns now that with recent federal government cuts that FEMA is at risk of not being as prepared for this hurricane season. Yeah. How does that flow into your risk modeling when you're trying to model for the impact of storms?
We look at it from the provision of care. How well are companies able to take risk management controls into protecting their property, protecting their people? And so from that vantage point, a risk management control perspective, it could be impactful, but we're a commercial underwriter. We don't really engage in the personal line space. Many of the companies we transact with have sufficient wherewithal to adopt risk management practices.
Gotcha.
Yeah.
Vince, great to see you and have you on set.
Thank you very much. Great being here.
All right, time now for what to watch Wednesday, June 11th. Let's start off on the earnings front here. We're going to be getting some Big names tomorrow. That will include Oracle, Chewy, and Victoria's Secret. Oracle, by the way, announcing results for the fourth quarter. It's after the market close. Analysts expecting Oracle's cloud unit to grow faster than expected, possibly more than 54% this quarter. It's based on results from other names in the space, such as Microsoft and CoreWeave.
And taking a look at the economy, we'll get fresh inflation data coming out in the morning with the Consumer Price Index at CPI. Economists forecast total CPI will hold steady at 0.2%, while core CPI could tick up to 0.3% on a month-over-month basis. On a year-over-year basis, total and core CPI expected to rise to 2.5% and 2.8% respectively.
And moving over to housing, weekly mortgage rate application data that's coming out in the morning. Last week's number decreasing 3.9% from the week prior, marking the third consecutive week of declines.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.